Hello students, welcome to the MOOC session of e-learning. Today we'll be discussing on the role of RBI in controlling current inflation. Now, what actually RBI, Reserve Bank of India, do? Reserve Bank of India is the apex institution which is called as bankers' bank, lender of last resort. Reserve Bank of India is the central institution which controls and monitors the financial activity of Indian economy over a particular period of time. Now, if we consider the preamble which was outlined to object the roles of Reserve Bank of India, it says that to regulate the issue of bank notes and holding reserves with a view of securing monetary stability in India, generally to administer the country's currency and credit system to its advantage. So this preamble is followed by Reserve Bank of India. The Reserve Bank of India was established on the April 1st, 1935, following the agenda which was taken by the Reserve Bank of India Act 1935. Reserve Bank of India was established by British Council. It was nationalized in 1949 after India got its independence. Its first office originally was located in Kolkata and now it shifted to Mumbai. The Reserve Bank of India's activity was completely under the government of India's control. Reserve Bank of India was started its activity from the 1934 or 1935. Actually, very specifically, it can be said that the activity was started from April 1, 1935, and its main objective is to control the inflationary pressure, control the price stability, and also the economic activity overall the period which is prevailing in the Indian economy, so that economy can go or economy can follow the original path of economic development and growth. It can also monitor the foreign reserve system and also the trade system which is prevailing in the Indian economy. Reserve Bank of India has some objectives over its period, and it has a monetary committee system which basically deals with different policies that implemented time to time to control the overall activity, monetary activity, financial activity, and also overall the economic activity, so that the economy can be at a stable place. Now, what is inflation? Inflation is the sustained rise of general price level of goods and services. Inflation can have a negative impact on the masses of Indian economy. Why? Because inflation, if there is higher rate of price rise over the period, it will have a negative impact on the poor class and also the medium income group class, because the salaried people and the lower income group people has a negative impact, because they have to consume their daily products by giving higher price, whereas the traders, businessmen, and the other entrepreneurs, they can have profit from this situation because they can have varied revenue when the general price level of goods and services changes. So inflation is a basic need to concern when we can say about the activities of Indian economy, when we can deal with the activity of Indian economy over a period, because the price stability and the currency system stability is very much important when we say about the economic development of India. Now, Indian economy is an emerging economy which continues different development process over the period. There are unprecedented activities also. If we consider the financial downturn, it took place from 2007 onwards. Recently, we have unprecedented outbreak of coronavirus, and this pandemic started in India from 2020 March onwards. So, there are some negative impacts of this type of unprecedented incidents on the Indian economy over a period. Now, how the economy can revive from this type of situation? Inflationary pressure on the economy can have some negative impact, as I have said, because it has different level of impact on the poor class, on the middle class, and on the richer classes. There is some shift of wealth and income from the poorer section to the richer section, and the distribution of income becomes skewed over a period of time if we consider the post-pandemic situation. So, this is very important to discuss about the role of Reserve Bank of India by implementing different policies in controlling the current inflationary situation of Indian economy. So, we can specify the objectives of the study. First of all, we want to discuss the role of RBI. Secondly, we will discuss the inflation and its effect on Indian economy. And thirdly, we want to specify some policies that can help to combat with the inflationary pressure which prevails in the Indian economy, so that the Indian economy can be stable according to its price level, its monetary level, and also its financial activities, so that Indian economy can take the path of economic development over a period of time. Now, if we consider the role of RBI and its activity overall the period, the Indian economy can have the system of finance, the system of monetary policy, the system of foreign exchange policy, and also the system of currency policy. Indian economy plays the pivotal role when we consider these different policies. Indian economy has the different types of committees which will basically deal with this type of problems which generates due to the inflationary pressure. The first of all, RBI plays the role of currency manager, financial manager, foreign reserve manager, and price system manager in the Indian economic system. Now, if we specify some role which have been performed by the RBI traditionally, these are the banking system regulation, the government debt management, price control, credit control, the currency issuance, and also the monetary supply management overall in the financial sector. RBI also implements different types of monetary policies. All the policies basically help in controlling inflation. So, since our focus is in the inflationary policy measurement, so that we will focus on different monetary policies. If there is increase in the rate of interest, then the people will invest more, they will save more, and there will be more demand generated. And when the reverse process is required, then the rate of interest may go down, and all these can be dealt with the RBI. The second point is control of imports and exports. If there is the lower level of investment rate which prevails in the economy, then there will be different types of investment take place in the economy, so that the industry will manufacture most export oriented goods, rather than they will lower their import oriented activities, so that there will be promotional advantage in the balance of payment system also. The third one is managed business cycle. There is two types of activities take place in the business cycle. One is boom, another is recession. Now, when there is lower supply of money, then there will be less demand suggested by the producers and the consumers. So, there will be lesser aggregate demand take place in the system, and there will be lower level of business activity, and there will be control of inflation. All these are taken by the RBI. Next point is regulation of aggregate demand. If there is increase in aggregate demand, as I have already said, there is increase in consumption of goods and services, there will be produce of goods and services also. But if there is any kind of outbreak of supply shock, then the demand will not match with the supply. So there will be need for decrease in demand. That can take place if there is some policy implemented by the RBI. Next, we can say generation of employment. If there is extension of the entrepreneurial activity, if there is lower rate of interest rate prevails in the economy, the business may expand and there will be more laborer which will take place in the entrepreneurial activity, and there will be generation of employment. Next point we can say is infrastructural development. That can be done by RBI by offering some concessional funds. If there is some concessional loan with the lower rate of interest, then the infrastructural development overall the economy can be possible. We can say finally the managed and developed banking sector. That is discussed and advised by RBI again, because the RBI actually suggests some type of banking activity that they are playing, and also they suggest for other banks to play that. They can actually introduce the activities in the rural bank, agricultural bank, different financial banks, so that the rural area can give some support. The rural area can give loan. The rural area farmer will give some loan. They will actually do their agricultural activity by taking loan at a lower level of interest. So the commercial banks may take this type of initiatives under the guidance of Reserve Bank of India. These are the traditional activities that taken place in guidance of RBI, and those are actually monitoring the whole price system, the currency system, the economic system, and it will help the economic development of India as a whole. According to Professor Kaushik Basu, inflation has little to do with these changes in relative prices of goods and services, but it referred a prolonged rise in inflation because the increase in the general price level of goods and services that will take place in the Indian economy over a period of time. Now, inflation can have different impacts on the Indian economy. First of all, the inflation may take place due to demand pull effect. What is demand pull effect? When there is increase in demand of goods and services and it is not matched with the supply, then there is general rise in price level of goods and services, which is called demand pull inflation. And there is another type of inflation which is called cost push inflation. When there is increase in the input price of goods and services, suppose there is increase in the wage rate of the laborers due to the bargaining power of the trade union, then there will be increase in the cost of production, which will be affected the goods and services of the general customer, which are demanded by the producers and the customers of the Indian economy. So this type of activity is called cost push inflation. And there is another type of inflation which is called wage inflation, which comes out due to the increase in labor force. There is another type of inflation we can say which is profit inflation, that comes out due to increase in profit share of the firm. So, inflation has some effects on the Indian economy. First of all, it divides the poorer section and richer section. Secondly, there is skewed distribution of income and wealth over the period between the masses. And the third one is the decrease in real value of the goods and services, so that the purchasing power of the customer decreases. And if there there is decrease in the purchasing power, then there will be decrease in demand for the goods and services overall in the period, so that there will be a gap between the demand and supply of the economy, and then RBI has to play some role so that there is stability of price may come. There will be the price control system which will define where will be the price level for the goods and services in the economy. Now, if we consider the current situation of the different policies implemented by RBI, we will see that the CRR, SLR, repo rate, reverse repo rate, the bank rate, all are increased currently due to combat the inflationary pressure prevails in the Indian economy. Now, the necessary policies implemented by the RBI, we can say the first one is the flexible inflation targeting framework. The flexible inflation targeting framework actually deals with the target inflationary rate which was set by the government of India after discussing with the RBI. It revised its situation between a 5-year gap. So, it started from 2016 following the RBI Act, and it will end on March 31, 2021. Its target was set at 4%. So, the inflationary level can take at 4% level, but it has a lower tolerance level at 2%. It has an upper tolerance level at 6%. So, the RBI has a comfort zone between the 2% and 6%. If the RBI fails to achieve this type of inflationary pressure, this type of target it cannot set, then it has to provide the reason why it fails to achieve this targeted inflation. And there is another point it has to cover, that when it will be able to target that situation, when it will be able to meet that situation, and there should be some estimated time also, which will say that at this point of time this type of price level will prevail in the economy, so that there will be the targeted inflationary meet. The second one is the monetary policy deals with the quantitative tools also. There are some quantitative tools which will be applied to combat with the inflation. The first one is reserve ratio. The reserve ratio says that bank has to keep aside some amount of their liquid asset or Reserve Bank approved asset with the RBI. Now, this reserve ratio can have cash reserve ratio and statutory liquidity ratio. CRR, cash reserve ratio, is an amount of liquid cash which will set aside with the RBI, and if there is increase in CRR, there will be increase in rate of interest, so that the customers and the producers will not be able to consume more, and there will be a rush on the inflationary pressure. If we consider the SLR, SLR is the rate at which the Reserve Bank actually takes some amount of semi-precious stones, precious stone, and also some metals and golds from the commercial banks, so that they have to reduce their loan granting capacity, and the customers and producers has to take their loan at a higher rate. So, they will not be able to take many loans, so that a huge amount of loans, so that there will be again a depressionary pressure on their consumption level, and the rise of price will be controlled. Second, the open market operation, OMO, that takes place in the free market when RBI wants to sell or borrow some government securities from the commercial bank. Now, if OMO increases, there will be transaction between the commercial banks and the RBI, and there will be increase in interest rate or decrease in interest rate according to the necessity of the Indian economy and according to the inflationary pressure prevails in the Indian economy. The other monetary tools we can say about the qualitative tool. The qualitative tools are supposed to be the margin requirements, moral suasion, and selective credit control. The margin requirements basically says about the amount of collateral which the customer has to offer when they take loan. When the margin requirement increases, it means the customers are not being able to take huge amount of loan because they have to offer a huge amount of collateral also. So when there is increase in the price level, when there is inflationary pressure on the Indian economy, then the margin requirement increases, so that the purchasing power of the customer should be controlled. And there is moral suasion. This is the persuasion of the borrowed money from the commercial bank by the customer. If there is increase in rate of interest, again the customer will not be able to purchase more, not be able to take loan from the commercial bank for more purchase. So the purchasing power will decrease, the supply of money in the economy will be decreased, and there will be control over the price rise overall the economy. The third one is selective credit control. It also implemented by the RBI. When there is some specific sector increases its price level which will affect the masses, suppose the rice production, the manufacturing of wheat, the oil seeds, the khesari dal, and if this type of particular commodities increases their price, it will affect the overall masses. In this case, the RBI actually takes control to this type of segments, so that there will be implementation of selective credit control. Here, the producers do not get any kind of advance loan sanction, so that they can increase their price level and they can increase their marketing activity, and the price level increase will affect the masses of the economy. Overall, the things will be controlled by the RBI to control the inflationary pressure of Indian economy. Bank rate is actually the policy which deals with the borrowing of the general commercial banks from the market. It is a brief time agreement, and in this case the commercial bank don't have to pay any type of security deposits or any type of collaterals when they borrowed money from different type of agents from the market. So in this case, if there is increase in bank rate, it actually pressurizes the commercial banks to take lower level of interest rate and lower level of the loans from the market, and it will be very much implemented in the activities of the masses, because when the mass wants to take loan from the commercial bank, they will not get that type of loans at a lower level of rate of interest. The other one is the liquidity adjustment facility. Under this we have three types of policies. The first one is repo rate, at which the RBI lends different types of money amount to the commercial banks. If there is increase in repo rate, the borrowing for the commercial bank will be costlier. In that case, the loan granting amount will be reduced for the commercial banks, and this type of policy is called dear money policy. In that case, the producers and the customers will not take or will not be able to take large amount of loan from these commercial banks. If we consider the reverse repo rate, the reverse repo rate is the reverse of the repo rate, repossession rate or repurchasing arrangement. Here what happens, the commercial bank will actually they keep their liquid asset with the RBI. When there is uncertainty prevails over the market, there is uncertainty regarding the monetary sector, the financial sector, so that they will keep their extra liquid asset with the RBI. Now, what are the limitations of monetary policy in curbing inflation? We can point out there is incomplete transmission. The different types of activities which are taking place by monitor of the RBI, all are not transmitted to the other banks, to the masses, so that all the policies are not implemented thoroughly or properly. The second one is policy rates are not sometimes market linked. The market's activities are different and the policies implemented are somewhat different from that market activity, so that the effect of the activity, effect of the policies preference is actually changes what they wanted to say and what are implemented in the market. The third one is ineffective against supply shock. If there is supply shock of goods and services, as it is we are seeing in the Russia-Ukraine war, there is shock in the supply side, there is exogenous shock in the supply side, there is increase in food level, there is increase in price of food inflation specifically, then it cannot be actually controlled by the RBI. Implementing different types of monetary policy. The other type of policies are needed, other modification, amendments of the policy rates are needed. The last one is limited financial inclusion. There are some other types of financial activities, financial policies should be implemented so that the overall inflationary pressure can be controlled. And there is uncertain global scenario, it actually impacts on the overall activity of the economic system, of the financial system, and price stability also. So the global economy should be considered, and according to this, the monetary policies should be amended or should be modified to properly adjust the inflationary pressure of goods and services overall in the period. Now, if we conclude that the role of government, the role of RBI also takes some important role, important activity for the combat, if we want to combat with the inflationary pressure overall prevails in the Indian economy. But some economists say that the certain level of inflation is very good for any economy because there is growth and inflation trade-off is necessary. So certain level of inflation should prevail in the economy. RBI has to monitor that type of targeted inflation. After that is reached, then this policy implementation should be important. And the second one is the increase in repo rate or increase in reverse repo rate. These are not the only solution to control the inflation. There should be some other financial policies, fiscal policies also, which can be matched with the monetary policies, so that there will be a combination of different policies, modern policies, amendmented activities that will prevail in the economy to combat with the inflationary pressure overall in the economy. The third one is, it is commonly acknowledged that controlling an economic phenomenon is not very easy for Indian economy, because India is one of the largest constitutions and democratic country. Its activities are huge, its developmental promotional activities are continuing over the period, which is very much complicated. So it is not very easy to control the inflation at a phase with implementation of different types of only the monetary policy or only the fiscal policy. The traditional policies like the issuance of bank notes, the system of reserve, foreign reserve, the foreign direct investment control, there are different types of price controls that should be there, with the combination of different rates of repo rate, different policy rates of regarding the reverse repo rate, the bank rate, the cash reserve ratio, the statutory liquidity ratio, all of them should be combined so that there will be The traditional approach of artificially pushing down the demand by increasing the repo rate or reverse repo rate is not the only solution to combat with the inflation. There are some traditional tasks done by the RBI, that is the changes in the repo rate, reverse repo rate, there is change in the bank rate, there is issuance of bank notes, and with this there will be mix up of fiscal policies and different types of policy rates. There are moderation of the banking system, there will be the moderation of the Reserve Bank Act, so that there will be modern activities, there will be modern amendment of the overall policy, overall monetary policy that is implemented by the RBI or the Central Bank of India, and all of them as a whole will be helpful to control the overall inflationary pressure of India. It will be helpful for the current situation, and also it will be helpful for the near future also. So, according to different economists and policy makers, that the good combination of the demand side factors and the supply side factors, also the good combination of the policy related to monetary sector and the fiscal sector will help to combat the overall inflationary pressure prevailing in the Indian economy.